we'll see. There's talk now that maybe as soon as next Friday, the 20th, the Supreme Court will finally rule on the constitutionality of Trump's tariffs. Again, all these different variables that have been driving the price of silver, can always change. But if we just kind of go back to the basics, and that is the gold price and the silver price in relation to the gold price, then there should be a lot of support there, because I don't see a scenario where gold comes plummeting back to 3,000.
There's been a ton of Chinese buying. They like to gamble. It became very speculative, and I think that's a lot of what contributed to this huge run up to, eventually $110, $120. But so, it's kind of moderated now. I think we are in a bit of a consolidation phase, but none of the drivers, none of the fundamentals, and none of the economics, the macroeconomics have changed one bit. They've only gotten sort of more bullish. So I think we're heading higher from here later this year.
Silver markets remain in consolidation despite ongoing macro uncertainty, including potential tariff rulings and shifting global trade dynamics. Analysts Craig Hemke and Peter Krauth suggest recent volatility reflects speculative excess rather than weakening fundamentals. Strong Chinese demand and elevated gold prices continue to provide structural support for silver. While prices have cooled from recent highs, key drivers, monetary instability, inflation concerns, and robust physical demand remain intact. With gold holding firm, the gold-silver ratio implies underlying value in silver. As macroeconomic pressures build, both analysts expect renewed upward momentum later this year, reinforcing the broader bullish outlook for precious metals investors. Now we present the clips from Craig Hemke and Peter Krauth's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I've been buying silver and gold for 15 years. I've got silver that I bought at $12 back in March of 2020. I've got my average cost basis is like 19. It might be higher than that because I continue to buy some. So anyway, that's always the best strategy. You don't want to, unless you're just some kind of really aggressive trader, just shove all your chips onto the table at any kind of price when anything can happen, like what we saw yesterday, is not very smart, at least in my book. Going forward from here, we were really rolling into the end of last year and got a lot of volatility between Christmas and New Year's. It was the 1st of January when the Chinese export controls went on. And, they were announced in October, but they were effective January 1st. And that was really when silver just took off for the, 4 weeks. As long as that doesn't get rescinded, and we'll see, there's talk now that maybe as soon as next Friday, the 20th, the Supreme Court will finally rule on the constitutionality of Trump's tariffs. Again, all these different variables that have been driving the price of silver, can always change. But if we just kind of go back to the basics, and that is the gold price and the silver price in relation to the gold price, then there should be a lot of support there, because I don't see a scenario where gold comes plummeting back to 3,000. There's a reason. Gold, kind of on just an aside, Elijah, the traditional stockbroker trader mindset is that the dollar is the stable unit and the price of everything goes up and down versus the dollar. That's, how they look at stocks and things like that. But you can't look at gold that way, because the gold never changes. The gold is just the gold. And so it's actually the gold that's the stable unit. It's the dollar that's changing. It took, $1,100, $1,200 to buy an ounce of gold 10 years ago. It took $2,000 to buy an ounce of gold 5 years ago. It now takes almost $5,000 to buy an ounce of gold. The gold is always the same. It's the abundance of all these dollars, because of the monetary system, that is making the gold appear to go up in price. And so as long as gold continues elevated, and nothing to suggest it's going to pull back sharply and break the trend that it's on, well, then that's going to provide a lot of support for silver too, just by extension. People go, well, gold's $6,000. Why isn't silver $90, at a 75 gold silver ratio? So again, anything can happen in the short term. Obviously, we get those lessons almost every day, but in the bigger picture, dollar cost averaging, like you said, owning physical metal as a protection against the monetary madness is just, to me, the best strategy. It is a direct correlation to record central bank gold demand over the last 4 years. That happened in early March of 2022. And 2022 was a huge year, 23, 24, 25, and now into this year. And it continues. I had Central Bank of Poland just announced, a few weeks ago, they're going to add another 150 metric tons. Even things like Tether. Tether's averaging about 25 tons a quarter, 100 tons a year. So that central bank gold demand is not going away. And the lesson has been learned. As it relates to Russia, I would imagine, I don't know if that was originated in Russia, if it was floated as a trial balloon to try to get Russia to the negotiating table regarding Ukraine. But that's quagmire. It doesn't seem to be ending. I mean, Trump thought it'd be, just by power of personality, he could get it ended in the, first couple of days of his presidency. So are they floating a little, carrot at the end of the stick for Russia? Hey, we'll let you back into SWIFT if you, withdraw from Ukraine as part of a negotiating ploy? Because Russia can say, hey, we're going to start using the dollar again. But if they're excluded from SWIFT, what good does it do? I mean, it has to come from the U.S. first.
Long-term precious metals investors continue favoring dollar cost averaging amid volatility in gold and silver markets. Analysts like Craig Hemke emphasize owning physical metal as protection against currency debasement and monetary expansion. With sustained central bank buying, including purchases by the National Bank of Poland, structural demand remains strong. Ongoing geopolitical tensions involving Russia and global trade uncertainty further support safe haven flows. While short-term swings persist, elevated gold prices continue underpinning silver's long-term bullish outlook. Let's get back to the interview.
I have been saying for the past year and a half that was what was going to lead to what we just saw over the last, say, 3-4 months. And I think that's what happened. We saw by last spring, we saw the market come to terms with the fact that there is not enough silver out there, and that the only way we would get silver coming, any kind of even minimal relief was private holders selling it back into the market. And I said that wouldn't happen at $40 or $50. It was going to happen at $70 or $80. And to some extent that started to happen. But what's interesting too is that, there's all kinds of bottlenecks in the system. First of all, like you say, there's only so much silver on the major exchanges. For the most part, they've all been drained. We can see some of it's flowing into the silver ETFs. We've seen that SLV kind of bottomed. I think it was by the middle of 2024, and it's been trending up pretty strongly since then. And globally, silver ETFs have reached their previous peak, but the SLV has not. So what it suggests to me is that in the West, we haven't been participating quite to the same extent as they have in the East. There's been a ton of Chinese buying. They like to gamble. It became very speculative. And I think that's a lot of what contributed to this huge run up to, eventually $110, $120. But so, it's kind of moderated now. I think we are in a bit of a consolidation phase, but none of the drivers, none of the fundamentals, and none of the economics, the macroeconomics have changed one bit. They've only gotten sort of more bullish. So I think we're heading higher from here later this year. Silver is not easy to come by. And if you've got big industrial consumers who are finding every possible way to get their hands on it, and if some of it is by holding long contracts, futures contracts, and waiting for them to mature to take delivery, and at some point, one of the major exchanges, I think it's maybe unlikely to be the Shanghai because it's built to be for delivery, whereas the LBMA and the COMEX are not. I'm not an expert in these markets, but that's my understanding, that it could be one of those two that fails, so to speak, and someone stands for delivery and they're told, sorry, force majeure, we can't deliver, we don't have the silver, we'll settle you in cash. And they'll say, no, I don't want the cash, I want the silver. And that's when we're going to really hear that. And that could be, sort of the last straw. But you're right. The industrial demand is what has been, I think, essentially providing this rising floor under the silver price. And it's the physical, or I should say the investment demand, that really has come in a big way and has in the past been what has caused these spikes. I'm not even sure if this last spike was not a bit of both. I would think it was mostly investment that really caused it, because that's sort of, fast, I'm going to say dumb money in some ways. And people get caught up in this stuff and they just, feel like, oh, I'm going to miss this boat. There's a lot of FOMO, and then they just keep buying and buying and buying, and then there's no one left to buy. And the smart money knows that it's going to correct. But yes, I think that can be a risk. The Silver Institute said that over the next 5 years, they expect ongoing deficits, and that we will actually see a new record deficit in the silver market. So it's not going away, and none of the projections I've seen for new supply coming from miners gives me hope for anything more than 1 or 2% growth in mine supply per year. That's nowhere near what the market needs. We're in a deficit of anywhere from 10 to 20% of annual supply. We're consuming 10 to 20% more annually than we get from mining and recycling combined. And Steve, I was looking at, there was an update from the Silver Institute back in November. So they put out their numbers every year, and that usually comes out in April for the year. They project what they think will happen for 2025, the last time around, the World Silver Survey. And then when November runs around, as most of the year has gone by, then they update their projections, and hopefully they'll end up being a bit more accurate. Well, what's interesting is that they show net investment in silver ETFs as a separate line item. So they show it separately from what they call the market balance, meaning surplus or deficit for the year. So what's interesting is that if you look back at the April survey, they thought that the investment into ETFs was going to be somewhere around 70 million ounces. And I remember saying at the time, that looks really wrong to me. I don't see that happening. I think we're going to see a lot more money flowing into the investment side of it. Obviously, some of it's physical, coins and bars, but some of it is into the ETFs that hold the physical. And it turns out that when they redid their estimates for 2025, that the flows into ETFs was going to be more like 200 million ounces. That's almost 3 times what they expected originally. And if you look at the market balance, including investment into ETFs, their estimate for 2025 is going to be an all-time high deficit. So this is a really, really tight market, and I don't see that improving. So the support for high prices is absolutely there.
Silver markets remain structurally tight as persistent supply deficits collide with rising industrial and investment demand. According to data from the Silver Institute, XF inflows surged far beyond earlier projections, contributing to what could be a record annual deficit. Major exchanges like the COMEX and London Bullion Market Association face ongoing inventory pressure. With mine supply growth limited and global demand expanding, silver's consolidation phase may precede renewed upside momentum later this year. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.